I want to tell you about something that happened in my office back in 1997 that I still think about today. A man came to see me, 42 years old, successful career in corporate finance, and within 5 minutes of sitting down, he started crying. Not tearing up a little, but actual sobbing. He'd been saving money religiously for 20 years, had over $350,000 in various savings accounts and certificates of deposit, and he just realized he was broke. Not broke in the traditional sense, but broke in the way that matters most. He had no path to the life he wanted, no way to retire with dignity, no ability to help his children, and most devastating of all, he'd wasted 2 decades doing exactly what society told him was the responsible thing to do. I've watched men lose millions in bad investments and maintain their composure. But this man's realization that he'd followed all the rules and still lost was absolutely crushing to witness. That conversation changed how I talked about capital deployment for the rest of my career, because saving money, the way most people practice it, is one of the most financially destructive habits you can develop. I know that sounds insane coming from someone who's known for being careful with money, but hear me out. Because what I'm about to explain has been systematically kept from working people for generations. And understanding it is the difference between dying comfortable and dying wealthy. Well, let me start with two people I knew in Pasadena. I'll call them Robert and William. Both started at the same aerospace company in 1968, making essentially the same salary, about $18,000 a year, which was solid middle-class income back then. Robert was a saver, lived modestly, brown-bagged his lunch, drove his car for 15 years, put away 15% of every paycheck without fail, and by 1988 he had accumulated roughly $350,000 in savings accounts, money market funds, and conservative certificates of deposit, paying maybe 6 to 8%. William took a completely different approach. He kept only 6 months of expenses in cash and deployed every other dollar he could spare into investments, not reckless speculation, but calculated opportunities. Apartment buildings in areas he understood, stocks of businesses he researched thoroughly, even a small stake in a friend's manufacturing company. By that same year, 1988, William's net worth was over $8 million. Same starting point, same income level, same 20-year period, but William ended up with nearly 23 times more wealth than Robert. The difference wasn't intelligence. Both were smart guys. The difference was that Robert saved while William deployed. Robert's money sat there slowly losing purchasing power while William's money worked, compounded, and multiplied. Robert thought he was being responsible, but in reality, he was engaging in one of the most irresponsible financial behaviors possible, letting capital die in accounts that barely kept pace with inflation. I need to take you back to a conversation I had with Warren in 1959, long before most people knew who either of us were. We were having dinner at some forgettable restaurant in Omaha, and Warren said something that fundamentally rewired how I thought about money. He said, "Charlie, the question isn't whether you can save money. Any disciplined person can do that. The real question is what you do with it after you've saved it, because saved money is just potential energy. It only becomes actual energy when you deploy it into productive assets." I'd been practicing law, saving diligently, feeling proud of my growing savings account, and Warren's comment hit me like cold water. I realized I'd been confusing the act of saving with the act of building wealth. They're not the same thing at all. In fact, they're often opposing forces. Saving is defensive. It's about protecting what you have. Building wealth is offensive. It's about deploying what you have to create more. Most people spend their entire lives playing defense, and you cannot win a game when you only play defense. The best you can do is not lose, which means you've already lost. Let me break down exactly why saving money, as it's traditionally practiced, keeps you broke. And I mean this with mathematical precision, not as some motivational metaphor. First, There's what I call the inflation tax, and it's the most insidious form of theft ever created because it's invisible and socially acceptable. Let's say you save $100,000 in an account paying 2% interest, which is generous by current standards. If inflation is running at 3 to 4%, which is historically normal, you're losing 1 to 2% of your purchasing power every single year. That means your $100,000 is worth $98,000 in real terms after year one, $96,000 after year two, and so on. Over 20 years at just 2% real loss per year, your $100,000 has the purchasing power of $67,000. You've lost a third of your wealth by doing what society told you was safe and responsible. Now compound that across your entire working life, and you begin to understand why people who save diligently often reach retirement age and realize they can't afford to actually retire. They weren't reckless, they were obedient. And obedience to bad advice is still bad decision making. The second reason saving keeps you broke is opportunity cost, and this is where the real wealth destruction happens. Every dollar sitting in a savings account is a dollar that's not invested in productive assets, and the difference between savings returns and investment returns over time is absolutely staggering. Let's run the numbers with that same $100,000. In a savings account at 2% after 20 years, you have about $149,000. Sounds okay until you consider that in a diversified stock portfolio returning a historical average of 10%, that same $100,000 becomes $673,000. The difference is $524,000 in opportunity cost. Wealth that could have been yours but isn't because you chose safety over growth. But it gets worse, because that $524,000 itself would have generated returns in subsequent years. So you're not just losing the money, you're losing all the future money that money would have made. This is what I mean when I say that saving money is one of the most expensive things you can do. The opportunity cost is massive, and it compounds negatively over time. Third, and this is psychological but equally important, saving trains your brain for scarcity, while investing trains it for abundance. When your primary financial behavior is saving, you develop what I call a defensive money mindset. Your goal becomes not losing, protecting, defending, holding tight. This mindset makes you risk-averse in exactly the moments when you should be risk-tolerant. It makes you focus on what could go wrong rather than what could go right. And most destructively, it makes you view money as a finite resource to be hoarded rather than as a tool to be deployed. I've watched this mindset destroy more financial potential than bad investments ever could, because it prevents people from even considering opportunities that could change their lives. Meanwhile, when your primary financial behavior is investing, even if it's cautious, calculated investing, you develop an abundance mindset, you start seeing opportunities instead of threats, you become comfortable with calculated risk, you understand that money is meant to move and multiply. This psychological difference is why William from my earlier story ended up with $8 million while Robert had $350,000. It wasn't just the returns, it was the entire way they thought about and interacted with capital. The fourth problem with saving is what I call the velocity issue, and this is pure physics applied to finance. In physics, an object at rest tends to stay at rest. An object in motion tends to stay in motion. Money works exactly the same way. Money sitting in a savings account is at rest. It's inert. It's not creating connections or opportunities or expertise. Money deployed into investments is in motion. It's interacting with markets, businesses, real estate, creating value and returns and knowledge. Here's something most people never realize. When you invest in something, anything, you develop expertise in that area that makes future investments better and safer. Your first real estate investment is scary, your 10th is routine, Your first stock purchase is confusing. Your 100th is intuitive. But if you just save, you never develop that expertise. You never build that investment muscle. So you remain perpetually inexperienced and therefore perpetually vulnerable. I've met 70-year-olds who've saved for 5 decades and are still terrified to invest because they never built the skills. They spent 50 years getting good at something that doesn't scale or compound. Meanwhile, someone who starts investing at 30, even with mistakes and losses along the way, has developed by 50 a level of financial sophistication that makes them essentially unfoolable. They've seen enough cycles, made enough decisions, learned enough lessons that they can spot good opportunities and avoid bad ones almost instinctively. The fifth and most tragic reason saving keeps you broke is that it creates an expertise gap that widens over time until it becomes unbridgeable. Let me explain what I mean with a real example. I knew a doctor, Sarah, making over $400,000 a year, absolutely brilliant in her field, saved like a champion, and by age 55 had accumulated $2.4 million in cash equivalents, earning essentially nothing. She came to me terrified because she just calculated that even with that much saved, she couldn't maintain her lifestyle in retirement without working until 75. How is this possible? She made huge money, saved discipline for 30 years, had multi-millions in the bank, and still faced a retirement crisis. The answer is that while she was saving, inflation was eroding her purchasing power, opportunity cost was stealing her potential returns, and most importantly, she never developed the expertise to deploy capital effectively. She was a complete beginner at investing at age 55 because she'd spent 3 decades avoiding it. Her peers, who'd been investing since their 20s, had 30 years of knowledge, pattern recognition, and confidence that Sarah didn't have. So even though she had more cash, they had more wealth and more capability to generate future wealth. She was cash rich, but opportunity poor. And opportunity is what creates actual long-term security. Now let me tell you what happened with Sarah because it illustrates something crucial about the transition from saving to deploying. She hired an advisor, nothing wrong with that, and the advisor put her into a standard portfolio of stocks and bonds, 60-40 allocation. Very conventional. She was terrified the entire time because she had zero foundation for understanding what she owned or why. No mental models for thinking about investments, no experience with market volatility, nothing. 6 months later, when the market dropped 12%, she pulled everything out, locked in her losses, and went back to cash. She'd destroyed hundreds of thousands of dollars of wealth because she panicked. And she panicked because she had no expertise. Compare that to someone who'd been investing since their 20s. They've lived through market drops. They understand they're normal. They know from experience that you don't sell in a panic. They might even get excited about buying opportunities. Same market event, completely different outcome, based entirely on expertise level. This is what I mean when I say that saving keeps you broke. It's not just the lower returns. It's that it prevents you from developing the single most valuable financial skill there is, the ability to deploy capital effectively under varying conditions. Here's something Warren and I figured out early that changed everything for us. The goal isn't to accumulate money. The goal is to accumulate capital allocation skill. Money is just paper or digital numbers. It has no inherent value. The skill of knowing where to put it, when to put it there, how much to put, and when to pull it out, that skill is infinitely valuable and it compounds over your lifetime. Someone with great capital allocation skill and modest capital will end up wealthier than someone with poor capital allocation skill and significant capital every single time. But here's the problem. You cannot develop capital allocation skill by saving. You can only develop it by allocating capital, which means you have to actually do it with real money, with real consequences. There's no simulation or book learning that substitutes for having your own money at risk and making actual decisions. This is why I always told young people that the most valuable investment they could make was in their own financial education through actual experience. Even small investments teach you things that no amount of saving ever will. Let me give you a specific example from my own life that drove this lesson home. In 1962, I invested $1,000 in a small oil royalty deal. It was a tiny position, almost nothing. But I researched it carefully, understood the geology, the economics, the people involved. That one investment taught me more about evaluating opportunities, reading contracts, assessing risk, and thinking probabilistically than 10 years of saving ever could have. It ended up paying me about $70,000 a year for over 60 years, turned a $1,000 investment into multiple millions in total returns. But the financial return wasn't even the most valuable part. What was valuable was the learning. I discovered I could evaluate complex opportunities outside my primary expertise. If I did the work, I learned how to structure deals. I built relationships with people in the oil business who became sources of future opportunities. I developed confidence that I could think independently and reach correct conclusions, even when they differed from conventional wisdom. None of that learning happens if that $1,000 sits in a savings account. Zero learning, zero growth, zero development of the skills that eventually made me wealthy. Now let me address what I know some of you are thinking, Charlie. Saving is safe. Investing is risky. Surely there's value in safety, especially for people who can't afford to lose money. This is where we need to completely reframe what risk actually means, because I'd argue that saving is far riskier than intelligent investing. You're just not thinking about the risks correctly. When you save, you have a 100% guaranteed risk of losing purchasing power to inflation, a 100% guaranteed opportunity cost, a 100% guaranteed failure to develop investing expertise, and an extremely high probability of reaching retirement without sufficient assets. Those aren't hypothetical risks, they're certainties. Meanwhile, when you invest intelligently in a diversified portfolio of productive assets, yes, there's volatility, yes, there's uncertainty, but over any reasonable time horizon, the probability of loss approaches zero, while the probability of significant gain approaches 100%. The stock market has never failed to recover from any downturn in history. Quality real estate in growing areas has consistently appreciated value. So which is actually riskier? The guaranteed erosion of saving or the temporary volatility of investing? I'd take temporary volatility over guaranteed erosion every single time. And so should you. Here's another critical point that gets missed in the saving versus investing discussion. The timeline question. Saving makes sense for short-term needs. Money you'll need in the next year or two should absolutely be in cash or cash equivalents because you can't afford the volatility. But money you won't need for 10, 20, 30 years? Keeping that in savings is financial malpractice. The longer your time horizon, the more investing dominates saving in terms of both returns and safety. Let me say that again because it's counterintuitive. Over long time periods, investing is actually safer than saving because the risk of inflation and opportunity cost outweighs the risk of market volatility. A properly diversified investment portfolio held for 30 years has essentially zero probability of underperforming savings. But savings have a 100% probability of underperforming investing. Yet most people act exactly backwards. They save for the long term and think they're being conservative when they're actually being maximally risky. I want to tell you about another person I knew, I'll call him James, who figured this out earlier than most, and it changed his entire trajectory. James was a teacher, not a high-income profession. Started at about $32,000 a year in the late 70s. But James understood something that Robert the Saver never did, that wealth isn't built by how much you make. It's built by how effectively you deploy what you make. From his very first paycheck, James kept 3 months of expenses and savings and invested everything else. He started with a single rental property, a small house he bought for $38,000 with a 20% down payment. He was terrified, thought he was being reckless, but he'd done the math and knew it could work. That first property cash flowed about $100 a month after all expenses. Not life-changing money, but it taught him the rental business. 2 years later, he bought another property, then another. Then he started buying small apartment buildings. By the time James retired at 65, he owned 17 properties worth over $11 million, generating about $48,000 a month in net rental income. Starting salary of $32,000 a year, career peak of maybe $70,000, but retired with passive income of over $500,000 annually. How? He deployed rather than saved. He developed expertise rather than hoarding cash. He understood that money sitting still is money dying slowly. The contrast between James and Robert, both real people I knew, both started with modest incomes, both disciplined with money, but one ended wealthy and one ended comfortable at best. That contrast teaches us everything we need to know about the difference between saving and deploying. Robert felt smart every time he made a deposit into his savings account. He felt like he was winning, being responsible, doing the right thing. James felt scared. With every property purchase, felt like he was risking too much, constantly questioned whether he should just save like everyone else. But 30 years later, Robert had security while James had freedom. Robert could survive, James could thrive. Robert had to watch every dollar in retirement. James never had to think about money again. The irony is that Robert felt safe the entire journey and ended up vulnerable, while James felt vulnerable the entire journey and ended up safe. This is the fundamental paradox of wealth building that most people never grasp. The path that feels safe is dangerous, and the path that feels dangerous is safe, assuming you're intelligent and calculated about it. Let me now get into the practical framework for transitioning from being a saver to being a deployer, because I know that intellectually you might understand everything I've said, but emotionally it feels impossible to actually do it. The psychological barriers are real and they need to be addressed systematically. First barrier is fear of loss, and this is the big one. People who've spent years accumulating savings feel physical pain at the thought of investing and potentially losing it. The solution isn't to eliminate the fear, it's to reframe what loss actually means. When you keep $100,000 in a savings account and inflation runs at 3%, you've lost $3,000 of purchasing power that year. That's an actual loss. It's just invisible, so you don't feel it. When you invest that $100,000 and the market drops 10% temporarily, you see a loss of $10,000 on paper and panic, even though it's not a real loss unless you sell. And historically, the market has always recovered. So we have visible temporary losses that cause panic versus invisible permanent losses that go unnoticed. The solution is to make the invisible losses visible. Actually calculate how much purchasing power you're losing to inflation every year, write it down, look at it regularly, and compare it to the temporary volatility of invested capital. When you do this exercise honestly, investing becomes less scary because you realize you're already losing money with the supposedly safe approach. Second barrier is complexity. People avoid investing because it feels complicated and they don't want to make mistakes. This is legitimate, but the solution isn't to avoid investing, it's to start simple and build complexity over time. Your first investment should not be researching individual stocks or buying apartment buildings. It should be a simple, low-cost index fund that tracks the entire stock market. You're essentially buying a tiny piece of every major company in America or the world. Instant diversification, minimal decision-making, historically excellent returns. From there, you can add complexity as you learn, maybe add some real estate, some individual stocks you've researched, some other asset classes, but you start simple. The people who stay in savings because investing feels complex are making the same mistake as someone who never learns to swim. Because they don't want to join the Olympic team, You don't have to be Michael Phelps to benefit from getting in the water. You just need to start somewhere appropriate for your current skill level and build from there. Third barrier is lack of knowledge, and this one requires a mindset shift. Most people think they need to learn everything about investing before they start, so they read books, watch videos, attend seminars, and never actually invest because they never feel ready. This is completely backwards. The most effective learning happens when you have skin in the game, when it's your money at risk, when you're emotionally invested in the outcome. I learned more in my first year of actual investing than I could have learned in 10 years of theoretical study. So the framework is to start with small amounts you can afford to lose, invest them in relatively safe, diversified vehicles, and learn by doing. Your first investments will probably be mediocre, that's fine. You're paying tuition at the University of Capital Allocation, and it's the best education you'll ever receive. As you learn and gain confidence, you increase the amounts and sophistication, but you never delay starting while you wait to feel ready. Because ready is something you become through action, not through preparation. Fourth barrier, social pressure and comparison, and this one destroys more wealth than people realize. When you save aggressively, people praise you, call you responsible, hold you up as an example. When you invest aggressively, especially when you're younger, people question you, call you risky, tell you to be more careful. This social feedback creates enormous pressure to conform to saving behavior even when it's financially suboptimal. The solution is to carefully choose whose opinions you value and whose you ignore. If someone has achieved the financial outcomes you want, weight their advice heavily. If someone hasn't, acknowledge their good intentions and ignore their advice. Most of the people telling you to save rather than invest are themselves financially mediocre. They're sharing the conventional wisdom that kept them mediocre, and if you follow that advice, you'll get their results. This sounds harsh, but it's true. You cannot take wealth-building advice from people who haven't built wealth, any more than you'd take fitness advice from someone who's obese, or relationship advice from someone who's been divorced 4 times. Let me give you a specific example of how I'd approach this transition if I were starting today at different ages and income levels, because the approach varies significantly based on where you are in life. If you're in your 20s or early 30s with relatively low income, let's say $40,000 to $60,000 a year, the framework is simple. Keep 1 month of expenses in cash, put 6% into whatever retirement account gets you an employer match, because that's free money, and deploy every other dollar you can into learning investments. At this age and income level, the money itself almost doesn't matter. What matters is developing expertise. Buy a small amount of a stock you've researched thoroughly, not because you'll get rich from it, but because you'll learn how to research companies, how to read financial statements, how markets work, how your emotions respond to volatility. Save up and buy the cheapest property you can find that makes financial sense as a rental. Not because you'll build a real estate empire immediately, but because you'll learn how real estate works, how to evaluate deals, how to manage tenants and maintenance. You're investing in yourself and your education more than you're investing for returns, though the returns will come. By the time you're 40, you'll have 15 to 20 years of experience, pattern recognition, and confidence that people who spent those years saving simply don't have. If you're in your mid-30s to mid-40s with moderate to good income, let's say $80,000 to $150,000 a year, the framework shifts slightly. Keep 3 to 6 months of expenses in cash. That's your emergency fund, and it should be genuinely safe. Put enough into retirement accounts to maximize tax advantages, but once that's done, you're at a critical decision point. Most people at this stage keep accumulating cash because it feels safe, and they're afraid of making mistakes with larger amounts. This is exactly the wrong move. At this stage, you should be deploying aggressively into diversified income-producing assets. A good mix of stock index funds, maybe some real estate if you have the expertise or willingness to develop it, potentially some small business investments if you have relevant knowledge. The key is that you're not just accumulating assets, you're building cash flow. Every dollar of passive income you create is a dollar less you need from your job, which means you're buying freedom incrementally. Someone making $100,000 a year who builds up $20,000 in passive income has effectively given themselves a 20% raise and 20% more flexibility. They can take a lower stress job, work fewer hours, pursue passion projects, take bigger career risks because they have that base income supporting them. This compounds over time until you reach the magical point where passive income exceeds expenses and you're financially free regardless of whether you work. If you're in your late 40s to 50s with higher income but limited investing experience, this is the danger zone because you have significant capital but limited time to recover from mistakes and limited experience to avoid those mistakes. This is the demographic where I see the most financial destruction. People who save diligently for decades have multiple hundreds of thousands or even millions in cash and are terrified to do anything with it because they're not sure what to do and can't afford to lose it. If this is you, the framework requires more caution but still requires action. First, accept that you're going to need help. Hire a fee-only fiduciary financial advisor who has a legal obligation to act in your best interest, not someone who makes commissions on selling you products. Second, divide your capital into tranches. Maybe keep 1 year of expenses in cash. Put the majority into a diversified portfolio of low-cost index funds across stocks and bonds appropriate for your risk tolerance and timeline. And allocate maybe 10 to 20% to learning investments where you research and choose specific opportunities to build expertise. The goal is to immediately stop the erosion of your capital from inflation while simultaneously beginning your education in capital deployment. Yes, you're starting late, but starting late is infinitely better than never starting. I've seen people in their 60s make this transition successfully. It just requires humility to admit you're a beginner and discipline to follow a solid plan. One specific strategy I've seen work well for high-income professionals who are late to investing is what I call the cash flow conversion plan. Let's say you're a doctor, lawyer, consultant, or executive making $250,000 a year. You have $800,000 in savings, and you're 50 years old with limited investing experience. Instead of trying to become a stock-picking genius overnight, you focus exclusively on converting that saved capital into stable cash flow through the most boring possible investments. You put $500,000 into a diversified portfolio of dividend-paying stock funds and bond funds yielding maybe 4 to 5%. That's $20,000 to $25,000 a year in income. You take $200,000 and buy a small rental property in a solid area with positive cash flow. Maybe that generates another $8,000 to $12,000 a year. You keep $100,000 in true emergency cash. Now you've converted dead capital into about $30,000 to $37,000 of passive annual income without taking crazy risks or needing to become an investment expert. That passive income is about 15% of your current salary, which means you've bought yourself significant flexibility. More importantly, you're now learning 2 asset classes, stocks and real estate, building expertise that will serve you for decades. In 10 years, when you're 60, that passive income has likely grown to $50,000 or $60,000 due to appreciation and dividend growth, and you have 10 years of experience, making you much more capable of managing your retirement capital effectively. Now, let me address something that trips people up constantly, the question of how much to keep in savings versus how much to deploy. There's no single answer because it depends on your specific situation, but I can give you a framework. Emergency funds should be 3 to 6 months of essential expenses, not total expenses. You lose your job. You're cutting the gym membership, the streaming services, the dining out. So calculate what you actually need to survive. Multiply by 3 to 6 months. That's your emergency fund. Beyond that, money should be deployed, but here's the nuance. Deployed doesn't mean all in stocks or all in real estate. It means intentionally allocated to productive assets, which could include bonds, dividend stocks, real estate, business investments, even certain commodities or alternative investments if you have the expertise. The key word is intentional. You've thought about why that money is in that asset, what purpose it serves in your portfolio, what returns you expect, what risks you're taking. This is completely different from money sitting in savings by default because you haven't decided what else to do with it. One mistake I see constantly is people who've read just enough to be dangerous. They understand that saving is suboptimal, so they take all their savings and dump it into whatever investment is currently popular without understanding it. In the late 90s, it was tech stocks. In the mid-2000s, it was real estate. In recent years, it's been cryptocurrencies. They go from one extreme of never investing to another extreme of reckless, concentrated bets, lose money, confirm their fear that investing is dangerous, and go back to saving. This is worse than just saving because now they've lost capital and reinforced bad psychology. The correct approach is gradual, intelligent diversification where you're building a portfolio of different assets that you understand, that have different risk profiles, that perform well in different economic conditions. This isn't exciting. It's not going to make you rich overnight, but it's going to methodically build wealth while managing risk. And that's the only approach that works over decades. Let me tell you about one more person that illustrates the long-term compound effect of deploying versus saving. I knew a couple, I'll call them David and Linda, both teachers, combined income that peaked around $110,000 in today's money, never made big money. They started investing in their late 20s, early 1970s, just putting small amounts into a combination of stock index funds and rental properties, nothing sophisticated. When they retired in their mid-60s around 2010, their net worth was approximately $7 million, generating about $280,000 a year in passive income. Their friends who had the same jobs, same salaries, but who saved instead of deployed, typically had between $400,000 and $800,000 saved, generating maybe $16,000 to $32,000 a year in interest, not enough to retire comfortably. David and Linda's wealth was roughly 10 times their savers' friends, and their income was roughly 10 times higher. Despite having identical careers and similar salaries, the entire difference came down to one decision made 40 years earlier, to deploy capital rather than save it. That single decision and the discipline to stick with it through multiple market crashes, recessions, and periods of doubt created a 40-year divergence that resulted in completely different life outcomes. This is what people miss when they focus on the short term. They look at the annual difference between saving and investing and think it's not that significant, maybe 3 to 8% difference in returns, depending on the specific investments and time period. But that 3 to 8% annual difference compounded over 30 or 40 years is the difference between a comfortable retirement and an exceptional one, between leaving your kids nothing and leaving them millions, between having options and having obligations. The math is brutal in both directions. Small advantages compound into massive advantages. Saving is a small disadvantage that feels like a small advantage, which makes it psychologically dangerous because you don't feel the pain until it's too late to fix it. Here's my final framework for thinking about this, and it's how I've thought about capital for over 70 years. Money has exactly one job: to create more money. If it's not doing that job, it's failing. Savings accounts, checking accounts, cash under your mattress, none of that is money doing its job. That's money on vacation, money retired prematurely, money that's been benched from the game. The only money that's doing its job is money that's deployed into productive assets. Businesses, real estate, stocks, bonds, anything that generates a return above inflation. So when you have money sitting in savings beyond your emergency fund, you have money that's failing at its only job, and you're the manager responsible for that failure. This might sound harsh, but I think it's useful to anthropomorphize your money and ask, is my money working hard for me, or is it sitting around getting soft? If it's the latter, you need to put it to work. Not recklessly, but definitely purposefully. The transition from saver to deployer is primarily psychological, not technical. The technical part is actually straightforward. Open a brokerage account, buy some low-cost index funds, done. You're an investor. The psychological part is brutal because it requires you to act against decades of conditioning, social pressure, and instinctive fear. Every fiber of your being will scream that you're being irresponsible when you take money out of savings and put it into investments, especially the first few times. Your friends will question you, your family might worry about you, and your own anxiety will tell you to stop. This is where discipline and conviction matter. You have to understand the math well enough that you can override your emotions. You have to trust the historical evidence strongly enough that you can ignore the social pressure, and you have to commit to the long-term plan firmly enough that you won't panic and sell during inevitable downturns. Now I want to talk about something that nobody discusses when they give investment advice. The emotional cycle you'll go through when you transition from saving to deploying. Because understanding this cycle in advance is the difference between success and failure. In the first month after you deploy significant capital into investments, you'll feel anxious every single day. You'll check your account balance compulsively. You'll read every financial news headline with dread. You'll second-guess every decision you made. This is normal and it passes. In months 2 through 6, you'll experience your first market volatility. Your portfolio value will fluctuate, sometimes significantly, and you will have moments of panic where you want to sell everything and go back to cash. If you can resist this urge and stay invested, you'll begin to notice something interesting. The fluctuations start to feel less scary. You're building psychological calluses. Between 6 months and 2 years, you'll go through at least one significant market correction, maybe a 10 to 20% drop, and this is the critical test. Everything I've taught you will be put to the test in your own psychology. If you panic and sell, you've learned nothing, and you'll go back to being a saver with a story about how investing is dangerous. If you hold, or better yet, buy more when prices are down, you'll have passed through the fire and emerged as an actual investor. After 2 years, something magical happens. Investing becomes normal. Market fluctuations don't trigger panic, they trigger analysis. Down markets don't feel like disasters, they feel like opportunities. You've fundamentally rewired your relationship with money and risk, and this new wiring will serve you for the rest of your life. Now let me tell you about a conversation I had with a young man in 2008, right in the teeth of the financial crisis. He'd started investing in 2006, had built up a portfolio worth about $90,000, and by October 2008 it was worth about $52,000. He was devastated, felt like an idiot for investing instead of staying in cash, and called me asking whether he should sell and cut his losses. I asked him one question: has anything fundamental changed about the businesses you own pieces of through your index funds? Are people going to stop needing banks, food, energy, healthcare, technology? He said no, people will still need all those things. Then I told him, you don't have a financial problem. You have a psychology problem. The value of your holdings hasn't permanently decreased. The price has temporarily decreased, and price and value are not the same thing. If you sell now, you'll lock in temporary losses. If you hold and keep buying while prices are low, you'll look back in 10 years and realize this was the best thing that ever happened to your wealth. He stayed invested, kept contributing, and by 2018, that portfolio was worth over $400,000. The crisis that felt like financial death was actually a massive wealth creation opportunity, but only for people who understood what was happening and had the psychological fortitude to act rationally. This is what I mean about expertise and experience being more valuable than capital. That young man's ability to stay rational during the crisis, to separate price from value, to understand that volatility is not the same as loss, that came from 2 years of investing experience combined with a solid mental framework. Someone who'd been saving for 20 years and deployed their first dollar in 2007 would have panicked and sold in 2008, confirming their belief that investing is dangerous. Same market conditions, completely different outcomes, based purely on preparation and psychology. This is why I tell people to start investing young with small amounts. The experience you gain is more valuable than the returns, and that experience makes you capable of handling large amounts later without panicking. Here's another critical insight about the savings trap that I need you to understand. Saving is not just financially suboptimal, it's also professionally limiting in ways people don't recognize. When your financial strategy is to save every possible dollar, you make career decisions from a place of fear rather than opportunity. You can't take the career risk that might triple your income because you're terrified of disrupting your savings plan. You can't invest in developing new skills or credentials because that money needs to go into savings. You can't start a business or consult independently because you need the security of a steady paycheck to maintain your savings rate. So saving doesn't just keep you broke financially, it keeps you stuck professionally. Meanwhile, someone whose financial strategy is deploying capital into cash-flowing assets has created a safety net that allows them to take career risks. They can leave a comfortable job for a risky opportunity because they have passive income covering their essentials. They can invest in an executive MBA or specialized certification because they understand that's capital deployment. They can start a business because they're not dependent on a single income source. Over a career, these ability to take smart risks compounds into massively higher income, and that higher income gets deployed into more assets, creating a virtuous cycle. The saver, meanwhile, is stuck in the same safe career path, accumulating cash that's losing value, unable to take the risks that would actually improve their situation. I saw this play out with two lawyers I knew in the 1970s. Both graduated from good law schools in 1973. Both got jobs at solid firms. Both made about $30,000 their first year. The first lawyer, I'll call him Alan, was a saver. He lived modestly, saved aggressively, and turned down opportunities to leave the firm and start his own practice because he didn't want to risk his savings. He made partner eventually, career peaked at about $200,000 a year in today's money, retired with about $1.8 million saved. The second lawyer, I'll call him Thomas, was a deployer. He saved 6 months' expenses and invested the rest in rental properties and index funds. After 5 years, he had enough passive income that he felt comfortable leaving the firm to start his own practice. The practice struggled initially, but because Thomas had his investment income covering basics, he could afford to stick with it. The practice eventually became very successful, and Thomas sold it in 2005 for $12 million. He retired with a net worth over $20 million. Same education, same starting point, but wildly different outcomes because of different financial strategies that enabled different career strategies. Alan played it safe financially and professionally and ended up comfortable. Thomas took calculated risks financially and professionally and ended up wealthy. The financial strategy doesn't just affect your money, it affects every major decision you make in your life. Let me address one more psychological barrier that keeps people trapped in saving, what I call the specific versus general fear problem. When you invest, you have a specific fear. I might lose money in this particular investment. This stock might go down, this property might have problems, this bond might default. These specific fears are vivid and concrete, so they feel very real and very scary. When you save, you have only general abstract fears. Inflation might erode my purchasing power. I might miss out on better returns. I might not have enough when I retire. These general fears are vague and abstract, so they don't feel as urgent, even though they're far more certain to occur. Our brains are wired to respond to specific concrete threats and ignore general abstract ones, which is why people panic about a 10% market drop but ignore the 3% annual inflation that's definitely destroying their wealth. The solution is to make the general threat specific and concrete. Don't think inflation might hurt me someday. Calculate exactly how much purchasing power you're losing every single month and write it down. Don't think I might not have enough to retire. Run the actual numbers and figure out exactly what your savings will generate in income and whether you can live on it. When you make the abstract concrete, it becomes harder to ignore, and the relative risks of saving versus investing come into proper focus. I also want to address a particularly insidious form of the savings trap. What happens to people who achieve high incomes late in life? Let's say you struggle financially through your 20s and 30s, finally hit your stride professionally in your early 40s, and suddenly you're making $300,000 a year. You remember being broke, you remember the anxiety of not having savings. So now that you have income, you save aggressively, telling yourself you're making up for lost time. 5 years later, you have $750,000 in savings, and you feel secure for the first time in your life. But here's the problem. You're 48 years old, you have maybe 17 years until you want to retire, and $750,000, even if it doesn't lose value to inflation, which it will, is not enough to maintain a lifestyle supported by $300,000 income. You needed to be deploying that capital aggressively from day one of your high income years, but because of your previous financial trauma, you're doing the psychologically comforting thing instead of the financially optimal thing. I've seen this pattern destroy the retirement plans of dozens of high-earning professionals, doctors, lawyers, executives who got wealthy late and then made the catastrophic mistake of saving instead of deploying during their peak earning years. If you're in this situation, you need to understand that your window is short. You don't have 40 years for compound growth to work its magic. You have maybe 10 to 20 years, which means you need higher returns through intelligent deployment, not safety through saving. Here's a specific tactical approach for this situation. If you're in your late 40s or 50s, making high income and have significant cash saved, you need to deploy 70 to 80% of it immediately into a diversified portfolio tilted toward growth. I know that's scary, but the mathematics are unforgiving. 20% in cash and conservative bonds for true emergencies, 80% in a mix of stock index funds, real estate investment trusts, and maybe some individual opportunities you've researched thoroughly. Then with your ongoing high income, you're saving maybe 3 months of expenses and deploying everything else monthly into the same portfolio. You're essentially catching up through aggressive but intelligent deployment, and you have just enough time for it to work if you start now. If you wait 5 more years to feel comfortable, you've lost the race. This is harsh but true. High income earned late in life is a gift, but only if you deploy it effectively. If you save it, you've squandered the gift. Let me tell you about one final person, and this one is particularly important because it illustrates what happens when you get the transition right. I knew a man, I'll call him Richard, who worked in manufacturing his entire career, never made more than $75,000 a year, but he understood capital deployment instinctively. From age 25, Richard invested 75% of everything he saved, mostly in stock index funds with some real estate. He lived modestly but not miserably, drove normal cars, took normal vacations, had a normal life. By age 50, his net worth was about $2 million, generating roughly $80,000 in passive income annually. At that point, Richard did something brilliant. He semi-retired, took a part-time consulting role in his industry, making $30,000 a year, and spent the rest of his time doing things he loved: woodworking, traveling, spending time with grandkids. He lived primarily off his passive income, plus the part-time work, and let his investments continue growing. When Richard died at 84, his estate was worth over $18 million, all from a career that never broke $75,000 annual salary. His children and grandchildren are set for life. Compare that to Richard's brother, same family, similar income, who saved everything and ended up with about $900,000 at retirement, which generated maybe $36,000 a year in income, not enough to retire comfortably, so he worked until 78 and died with about $1 million. One brother achieved multi-generational wealth, the other achieved barely adequate retirement from essentially the same starting point. The only difference was capital deployment versus capital hoarding. I'll end with what happened to that 42-year-old man who cried in my office back in 1997. After he composed himself, we talked for about 3 hours about everything I've explained to you here. He was skeptical, terrified, but also desperate enough to try something different. He kept 6 months of expenses in cash and deployed the rest into a diversified portfolio, mostly index funds with a small allocation to rental real estate, once he learned enough to do it intelligently. The first year was psychologically brutal for him. The market went up and down. He panicked multiple times, called me questioning whether he should sell and go back to cash. I convinced him to stay the course. 26 years later, that $350,000 he had saved has grown to over $3.8 million, and he's been retired for 7 years, living comfortably on the passive income it generates. His friends who stuck with the saving approach mostly have between $600,000 and $1.2 million, which sounds like a lot until you realize it's not enough to generate the income they need to maintain their lifestyle without depleting principal. Same starting point, dramatically different outcomes, based entirely on one decision to stop saving and start deploying. He called me last year. He's 68 now, and he said, "Charlie, I still remember that day I cried in your office. I was mourning 20 years I'd wasted, but that conversation changed the next 26 years of my life. I only wish I'd understood this earlier." I told him, better late than never, and besides, now he has the knowledge and resources to teach his children and grandchildren, so they never make the same mistake, and that might be worth more than all the money. That's the choice in front of you right now. You can keep doing what feels safe, keep saving, keep telling yourself you're being responsible, and in 30 years you'll look back and realize you spent 3 decades getting poorer in real terms while thinking you were getting richer. Or you can accept some discomfort, learn to deploy capital effectively, build the skills and expertise that compound over decades, and in 30 years you'll be wealthy beyond what saving alone could ever achieve. The math doesn't lie, the historical evidence doesn't lie, and the real-world examples I've shared with you don't lie. Saving money as a primary strategy is keeping you broke. Deploying capital intelligently will make you wealthy. The question is whether you have the courage to act on that truth, and whether you're willing to feel uncomfortable in the short term to achieve security in the long term. Everything I built in my life came from understanding this one principle early, and everything I've watched other people fail to build came from their refusal to understand it. You now know what they never learned. What you do with that knowledge is entirely up to you.